Thanks so much for joining us for our next Ripple Ventures Tang Talk with Wes Tang-Wymer, co-founder and partner at Rucker Park Capital, to discuss the transitioning from later stage mega deals to early stage venture. Thanks for joining us in the Tang today, Wes. Now, just a quick background on Wes. He is the co-founder and partner of Rucker Park Capital, where he's been for 2 years, which is a $45 million US early stage VC fund based in New York. Prior to that, Wes was a SoftBank Group investor for 3 years and was the founding member of the global investment team and was a generalist focused on fintech, transportation, and logistics. Some of his investments include SoFi, Grab, DiDi, Kabbage, Lemonade, Uber, and countless others. Prior to that, Wes was a long-short equities analyst at Steve Cohen's .72 Asset Management for over 3 years. And before that, he was in investment banking at Morgan Stanley for 2 years. Thanks for joining us, Wes.
Thanks for having me.
I'd love to kick things off and talk about your investor journey, starting out on the investment banking side at Morgan Stanley, and how it influenced your views on evaluating and investing in companies.
Sure. So I think that the lessons that I learned from Morgan Stanley, particularly as it relates to maybe entrepreneurship, was much more about how I got there than what I learned on the job. So, I grew up in Cincinnati, Ohio, had a very suburban middle class type of upbringing, and went to a college close by, Miami University, and partly because I was unsure what I wanted to do with my life, and I got a generous scholarship. And it wasn't until late into my freshman year that I developed an interest in investing and decided to pursue a career in the field. And as many do, wanted to pursue a job as an analyst in an investment bank. Well, it turns out Miami at the time was not exactly a top recruiting school for employers in high finance. So I worked my butt off to try and get my foot in the door. And, in retrospect, it was really my first professional foray into pitching and fundraising. I made a crazy schedule for myself to take 20 hours plus a semester at school and do a bunch of self-guided reading and training to ensure that I was the best candidate for these banks that they ever saw if the opportunity to interview with them ever arose. So I called and emailed every person that I could find that had some remotely relevant connection to Wall Street. Chicago was the closest financial hub where all the major banks and branch offices, in the Midwest resided. And, I made that 5-hour drive multiple times for recruiting trips, which were basically coffee and ad hoc interviews that I manufactured, right? Had absolutely no money. So it was lots of sleeping on dorm room floors or, in apartments of friends in the city, and not exactly great rest the night before what felt like the most important interviews, that I ever had in my life. And so long story short, I secured an internship with Morgan Stanley and subsequently converted that into a full-time job. And sure, I learned a ton about, certain industries and how financial institutions advise and help capitalize businesses, but I think so much of that experience was about the hustle and the scrappiness of creating opportunity for oneself when the odds aren't in your favor. And it's certainly one of the qualities that we look for in the founders that we back. They're obviously, I think, way more creative than I ever was in their scrappiness and their hustle. But, I think it would have been harder to identify and appreciate that quality without having gone through that experience early in my professional life.
Yeah, that's amazing. That's a great lesson. I think a lot of people think that just, you walk into a Wall Street firm out of a school and they're going to hire you right away if you have good grades. But really, it's not about that. It's actually learning how to pitch yourself, which is also relevant to startups and raising your own fund, which we'll get into. But I remember, going to New York for the first time, pitching myself on Wall Street. And I didn't come from an Ivy League school. I didn't have the pedigree that a lot of these, other kids had. And it was about how to pitch yourself to get yourself to stand out from the rest of the crowd. So that's an amazing accomplishment and also a great lesson for you that probably has carried you through a long period of your career. I'd love to jump into your next move where you joined Steve Cohen's family office, .72 Asset Management in 2012 as a long-short equities analyst focused on the telco, media, and technology sectors. Can you tell us about your experience working at one of the world's most notable and high-intensity hedge funds and the lessons you learned as it relates to risk-taking and portfolio construction?
Sure. So I was one of two analysts working under a very successful veteran portfolio manager at .72. We had a $1 billion plus portfolio that was focused on technology companies, media companies, telecoms. And, the firm and job by nature was fast-paced, certainly high intensity, as you say. But, on top of that, by industry standards, our team should have been easily 3 or 4 times as big. So we were also pretty lean. But for someone who was in his early 20s, interested in learning the craft of investing, it was just an incredible place to be. And not to mention, if you think back, 2012 to 2014, that was a fairly active time for IPOs in technology, in the technology space in particular. You had, Facebook that came public, I believe it was mid 2012, and then Twitter later on. The first wave of like the fintech and logistics companies, Lending Club and Grubhub, as well as a series of Chinese internet giants like Alibaba and JD. So that was all around that time when I first sort of joined the firm. And there was this tremendous opportunity to learn these different industries and business models. I always think internet, kind of like AI now, covers all manner of sins. And to cover internet, companies as a broad theme on the public market side really was a passport to learn all these different domains that frankly had very little to do with technology in its true form, but much more about how you, obviously apply innovation and technologies to these rapidly evolving industries, right? So I tried to soak up as much of that as I could. And it was a great seat to see how management teams at these top firms were thinking about setting strategy, thinking about evolving their businesses in rapidly changing market conditions. At the same time, you're getting paid to be productive as an analyst, to research ideas, to pitch them, to get them into the portfolio. And so just given all that massive bandwidth constraint that we all had on us, it was a real lesson in understanding how to get to the 80-20, the essence of the things that were really important for these businesses and for these investment ideas and what's really going to matter as quickly as possible. And I think the other thing that I gained an appreciation for that I believe has served me well is just an appreciation for the role of markets and the importance of sticking to your process. You learn that markets are subject to times of exuberance, right? And also times of depression, right? Both of which can offer you opportunities when you're at a long short equities hedge fund, right? Where you're betting on both stocks to go up as well as stocks to go down. But you have to understand when there's an opportunity based on independent work and maintaining, discipline around a preset process, right? Because markets are usually right. They're right more often than they're not. And it's funny, every time you're making a trade at the current price, you're basically saying that you're smarter than market, right? Or that you possess a piece of insight that maybe the market has not yet factored in. And that's non-trivial, right? That's borderline conceited when you really stop and think about it, because there are so many intelligent investors often on the other side of these trades, many of whom could have spent way more time understanding this market or this business, or have spent way more money in doing the research than you might have, right? And so I think just having that balance and appreciation for the fact that, you are in a market environment where folks are really bright and are bringing a lot of intellectual horsepower into every decision that gets made, it gives you an appreciation for how important it is to do your own work, as well as that you have to stick to a process that you've put together, a game plan, so to speak.
Yeah, absolutely. I mean, sticking to a process in any type of investing is really hard to do, especially at the scale that you were doing it at. I can imagine the pressure you were under to make decisions and find those 80-20 investments, but also the pressure to sit on your hands when you didn't have all the answers, even though there was a great opportunity in front of you. And I think that probably relates a lot to the risk taking that you had to endure when you came from an investment banking world where you're always selling, selling, selling. And now you go to the buy side and you're always trying to wait for that right opportunity. What about risk taking and portfolio construction did you take away from that experience at Point 72?
Yeah, I think it's a lot of interesting lessons. Some of them port really well into venture and early stage, and some of them are really much more relevant for a market where you can trade in and out of securities, right? You can buy a stock in a liquid market and decide to sell it tomorrow, right? And having that level of liquidity presents a whole host of considerations that are different than in private markets, which is venture, right? Where you don't have liquidity every single day, and your holding periods are much longer, right? So from a risk-taking perspective, a lot of it is really just understanding and boiling it down to what is it that you're actually taking risk on, right? There are a whole host of things in public markets that can move against you. You don't have perfect information. And there's often information asymmetry in all different ways, right? You don't know why the person that you're buying the stock from could be selling, and you don't know what the business is actually doing over the course of a quarter in between earnings releases, right? So piecing together all of those things, knowing where you can have some comfort in the risk that you're taking relative to the potential reward of that risk, that is, 80, 90% of really expressing the investments and managing your portfolio, right? You can often be in a position where you think that you've done all the work, you might have even identified the right risk to take, but at the end of, once that trade plays out and, the business reports earnings or some other catalyst that you were playing for ultimately comes to fruition, you realize, oh, wow, the market didn't actually care about that catalyst, right? All of the things that you did based on your work kind of panned out, but, the market already was quote unquote pricing it in. And oftentimes understanding that risk versus reward as it relates to both where the market is, as well as, doing your own forecast and modeling of what the business is actually going to do, is this marriage of, what do you know that you don't think everyone else knows? And what do you think you know that everyone else probably knows? And going through the different flavors of that to sort of parse out risk was certainly a big lesson, right?
Yeah, absolutely. And the liquidity, portion brings a whole host of problems. The constant liquidity of the public markets brings millions of problems and situations that you don't deal with in the private side. But I do remember someone saying to me, there's only one reason you buy a stock, but there's a million reasons why you would sell a stock. So trying to figure out all the reasons why people are selling is really difficult, but there's only one reason you want to buy. It's because it's going up or you're covering a short, but we'll just let that be for now. I'd love to move over to that non-liquid side, which is the venture capital side, which is where you are now. And before you started Rucker Park, you joined SoftBank in 2015 and was a founding member of the global investment team focused on fintech, transportation, and logistics startups. What was the biggest challenge for you moving from the investment banking and hedge fund world over to such a well-established firm like SoftBank to make private investments?
Well, so I think, Matt, the reality is that, SoftBank as an investment platform was far from being well-established. And that was actually the impetus for me to join the firm in the first place. I saw on the public market side a lot of these private technology companies that were coming to IPO actually counted a lot of folks that I would consider my peers as shareholders already, right? And what I realized was that many of these companies were staying private for longer as traditionally public market investors were starting to reach for outsized returns, alpha, right? By getting into private stage investing, which for my seat wasn't that different than what I was doing on the public market side because, back in even 2014, 2015, the Squares and the Ubers of the world that were private companies already had operating metrics that could have made them public. They were just deciding to delay it further because they didn't have a problem of accessing that capital, right? So, between the desire to get more involved in that type of an investing, as well as to partner with operators, folks that were building, which obviously it's hard for you to do if you're on the public market side, I wanted to move into a role that provided those opportunities. And that was sort of a light bulb for me back in late 2014. It coincided with a transition for SoftBank to build out more of its institutional investment platform, right? The firm, of course, had been, technology investors for a really long time, harkening back to the first .com bubble. But this renewed effort to put together a team that would effectively redeploy billions of cash flow from the operating assets of SoftBank all into investing seemed like an ideal opportunity. And it's funny, I actually heard about the efforts at SoftBank when I was going to investment conferences, and the investor relations team would talk about the fact that they're starting to build out this effort and this platform. And I thought that sounded incredibly interesting. So I borderline stalked the guy from conference to conference just to learn more about the effort, and then ultimately got the opportunity to have a conversation with senior leadership at the firm. And a couple months later, in early 2015, I joined as, I think it was the fifth member of that global investment team. So while it wasn't an established firm, as a core unit, so much of the work in that phase of SoftBank was about setting up the infrastructure, right? And what type of processes would we want to adopt to form our, investment, strategy. And that was really interesting work. It let me scratch my itch of, being a builder and a quasi operator of sorts to help start a firm, while, enabling enabling me to have a way to get more involved in private technology investing and learn that trade.
Yeah, it sounded like your entrepreneurial itch kind of came out when you started to see more and more of these private companies that you could have invested in if they were public. They had the sort of same mechanisms that you were looking for in public companies, but they were getting funded by, SoftBank, and there was an opportunity for you to come in as a private investor and really understand what was happening under the hood before they ended up becoming public, where everyone got to see what was under the hood. And that was something I think that probably drew you in, as it did draw me in when I was thinking about leaving Wall Street to go into early stage private investing. Now, while you were at SoftBank, you invested in some of the biggest unicorns of the last decade, including Uber, Lemonade, Kabbage, SoFi, DiDi, and countless others. Can you tell us about your experience in working with some of these companies and the lessons you learned from leading those later stage rounds?
Yeah, so many things. I've had the opportunity and the privilege to work with a bunch of amazing operators and founders. And I call upon a lot of the insights that I learned over the years, from them. And, I try to pattern recognize a lot of the best practices and common mistakes that the companies that I had the opportunity to work with, faced when they were scaling their businesses, right? So a lot of it is situational specific, but, what's been really interesting in my early stage seat is to see how much the time compression has occurred in terms of, early stage companies facing a lot of the late stage challenges or strategic decisions that, companies like the ones that I worked with at SoftBank, face much later in their journey. I'll give a couple of examples of I think at a high level, what are some of the things that I continue to carry with me as good lessons, from that chapter? I think one is obviously a lot of these companies that we had invested in had grown to be enormously large and enormously successful. How do you preserve nimbleness, right? And a starter's mindset past those proof points of success and scale? And I think you'd be surprised. It's just a lot of it comes down to, having the right culture that served that's the core of everything that folks were doing. And then, all these different little hacks of how do you set up the right teams? How do you set up the right size of teams to go after problems and let that snowball into a larger effort when it deserved, the resources and potentially the capital and the time that most of these firms had, right? And I think when we think about early stage companies, it's exactly the same thing. You just try, tens and hundreds of little experiments and then let those snowball. But there's so much of, what is the core? What is the mission? And what will anchor us in terms of, is this the right thing to be doing? But then letting that openness and the mindset of experimentation persist even as you scale. I think that was a really important element of a lot of the companies that I worked with. I think the other one is, this concept of having a half-life of competitive advantages, right? We had an opportunity to be involved in highly competitive industries, at SoftBank, and other ones where seemingly no one really wanted to get involved, right? And so I think a lot of it is how defensible are these competitive advantages and how quickly do they erode in the face of capital, having been on both sides of that happening, right? So it helps us think about the value of brands and brand building, the value of product advantages and what the half-life might be on that before someone catches up and decides to either replicate, imitate, or in other forms, basically close that gap. And then when you think about superior processes, right, and value chains, things like that, it's been a good set of references to fall back on as I think about the best ways to support, founders in our portfolio now and that we can encounter in early stage, because you never know when you're going to wake up and find out your largest competitor just got 3 times as big, right? And where are you supposed to, allocate resources and your attention? What are things that you should really worry about versus what are things that you can, continue to build towards to focus on what you're doing as opposed to the noise that's out in the market?
Yeah, those sound like incredible references for, a couple of things. One, mission alignment, culture, and allowing it to grow as the organization changes and grows so that you have, a focused mission throughout the life of the company. A lot of times when you level up management, they bring in their own culture. When you raise a ton of money, culture starts to change and starts to whittle away throughout the organization. And it sounds like when you had really strong culture-driven organizations, they always ended up on the right side of the road because it was so embedded within the organization. And that's really important that your early stage companies also have that today. And then on the other side, competition sometimes really scares a lot of investors and a lot of founders. But it sounds like you embraced it and allowed you to navigate the waters better by having, maybe limited resources, but targeting where you wanted those resources to go. I believe that is the case as well. I don't think competition is a bad thing. And in fact, it justifies that there's a market there to be fought after. But the way that you allocate those resources in more of a sniper rifle approach rather than shotgun is something that you probably learned well from your time at SoftBank as well, right?
I think that's right. I think that for me, I think a lot about what competitive advantages are worth replicating, what competitive advantages, if you already have them, are worth protecting, right, fiercely, and what are invariably gaps that end up closing when capital comes into a new sector, right, and a new form of business. You see this time and again. And I actually think some of the best lessons were from Asia and China in particular, where anytime there seemed like there was a semblance of a good idea, you instantly had 10 to 15 companies all fighting over how to bring that product first to market, how to go after all these different metros or cities or regions in China, and how to basically shut everyone else down, right? And so oftentimes it's just like a gunfight, right? And everyone is just spending as fast as they can, building as fast as they can. But I think a lot of the lessons that ended up sticking with me are, oh, that's interesting. The competitor had 3 times as much capital, but it actually didn't necessarily change anything when you look at the 6 month after or 12 month after market share because of X, Y, and Z factor. It could be a brand affinity. It could be the fact that you've bundled yourself with a suite of products and services that are really hard to replicate. It could be that you're the hyper local competitor or player, and you know your market way better than everyone else. Or it could be that you're focused on this specific kind of niche angle to the market, and other folks need to route their entire R&D flow back through this arduous process and bureaucratic process of fighting for resource from a much larger platform, because that's not the only thing that they do. Whatever it is, I think going down the list of various things where you end up saying, okay, because of the company that we're building or the market that we're in, these are things that we absolutely need to fight tooth and nail to protect. Or, these are kind of things that we need to think about to appreciate that other people are going to come into our market, but let's move on. Let's build for our core customer. Let's maintain our strategy or whatever else.
Yeah, that's amazing. And I'm sure that's probably led to where you are today, which I'd love to talk about now, which is Rucker Park. So in 2018, you and your former SoftBank colleague, Marissa Campisi, left to start Rucker Park Capital. You raised your first fund of $45 million and have already made 9 investments. What made you want to start your own firm with Marissa? And how did you both come up with your investment strategy at Rucker Park?
Well, I'd have to say that all credit is due to Marissa for jumping first into building a new firm and then advocating for me to follow suit. Rucker Park certainly wouldn't exist if she hadn't had the courage to take that first leap. So Marissa and I worked together at SoftBank, which was an interesting meeting point for 2 very different paths in technology investing, right? Marissa really grew up professionally in the New York venture ecosystem and had spent her career focused on early stage. And I obviously came from the almost exact opposite end of the spectrum. And, we decided to build Rucker Park together because we saw an opportunity to combine our skill sets and build this new firm with a new approach. For me, the impetus to start a firm was about the opportunity to be deeply in the trenches with founders at the earliest stages of their business. Now, I got some taste of that on occasion at SoftBank. And it's usually when one of the companies was exploring launching an adjacent business. But by and large, help us build was not exactly a common theme with mature later stage companies, right? And then I think the other thing that really motivated me to start an early stage firm was that I was seeing many of the talented operators in late stage companies that I had the opportunity to work with go off and start or help build new businesses. Right. And that felt like a really big inflection point in the market where you saw this graduation, we like to say, of folks from the last wave of startups, that transformed antiquated, complex domains like transportation, right, or payments or travel, And, that's really valuable experience that was not available to founders and entrepreneurs from 20 years ago, right? Or 30 years ago. I think we felt like as they went off into building these new markets, there's all sorts of lateral application of their experience that is unique and unprecedented that we believe will result in the next generation of consequential startups. We wanted to set out and build a firm that finds and partners with these folks, leverages all of the different learnings that we had across the various parts of the startup journey, and through the crosscut of our experiences, company formation all the way to public markets. Our idea is that while we're completely and solely focused on early stage, we end up being a resource, and by extension, the folks that we've had the opportunity to meet and learn from across our journeys become resources for these early stage founders, many of whom are scaling way faster than the cohorts of companies before them in their domain. So that was really the big idea and mission that drew us to build Rucker Park together.
I love that. It sounds similar to your first transition from public markets, where you saw some of the public market investors going into later stage private investing, and then you hear about Softbank and you're like, oh, there's something here, I want to learn more about it, and then jumping over to that side, and then now seeing the founders that you backed at Softbank or other later stage investments go out and start their own companies again or funds again, and saw that transition happening going downstream, which is really amazing. And I know Marissa's background at Venrock and Greycroft also lends itself well to what you guys are building right now at Rucker Park, right?
100%.
So I'd love to talk about transitioning from later stage mega deals to early stage venture. I'd love to hear what are some of the common traits you noticed in successful founders at the later stage during your time at Softbank that you look for today in the early stage companies that you meet?
Yeah, no, I think the right traits for the right business is an idea that we believe deeply in. And the right founder market fit is not a one size fits all. So, in some ways it's a little bit hard to generalize, but I think a couple of the common traits I saw at later stage was one, we kind of talked about it, this strong sense of mission orientation, right? What you're trying to build, exactly where you're going with a higher degree of confidence about, that vision of the future that you want to pull everyone towards. That is something that was universal across the best founders that I had the opportunity to work with at later stages. Lemonade, which is an insurtech company that recently came public, is a great example of that. You can find their IPO roadshow actually online, I think on YouTube. And the way that the co-founders, Daniel and Shai, talk about the business in that video was exactly the same as the way that they were speaking about the business when I first met them in 2016, right? Having that continuity despite the tremendous growth that they've had, the bobbing and weaving that comes with building a new business is a more common characteristic in my mind than not across really successful founder-led companies. The other trait that I would say I had the opportunity to observe was this idea of simultaneously living way out in the future and also in the very immediate present. And I would say that this was much more observable in the online to offline businesses like ride sharing and others, where if you talk to the ride sharing folks, they could articulate a clear picture of what their business would look like in an autonomous world, in a world where food delivery was a much bigger share of overall food than what it was in 2015, 16, 17, what have you. And they can also tell you all the different stages that their business would need to go through to get there. So it's not like they were just living in la la land. They had a perspective on the evolution of their sector. But while they're living in that future, they're also just tediously focused on what the business looks like today, how it's running, how to improve operations. I mean, literally to the day, right? And that's a job that when you look at a lot of the founders and CEOs of these firms, they do not delegate. And so this juxtaposition of those two things, I think, is this incredible trait that certainly maps really well to these online to offline businesses where they're so operationally intensive and complex, right? But also you kind of need to think about what's your reason to exist and thrive 10, 20, 30 years from now, just given technological trends, right? And the last one that I would offer, no surprise, is the ability to identify and cultivate great talent, right? In the best firms that I've had the opportunity to work with, with great people, excellent operators, don't spend a lot of time down in the proverbial mailroom, right? They rise quickly through the ranks. It's highly meritocratic, and it was never a lull in trying to recruit the best talent possible. And people had different ways to do this, right? Some are just incredibly magnetic leaders, but others, inspired with their brilliance or conviction in that future, right? That mission that they were driving towards, and pulled in some really amazing people to work with them. But that far and away has enabled them to preserve a level of competitive advantage that would have been harder to come by if they couldn't get these great people to all row in the same direction.
Yeah, that's amazing. I love that, being a great storyteller and talking about the vision of where the company is going to be in 10 and 20 years, but understanding the numbers and the bowels of the organization on a day-to-day basis today is just as important. Obviously at DoorDash, every dasher at the company has to drive at least once a month because they want them to understand not only if you're a manager at the very top or at the very bottom, you understand how the organization works top down, day to day, but also have the ability to think about 10 to 20 years out. And that is definitely something that we try to find in our founders as well at Ripple, because if they can't do everything from BDR and marketing all the way up to storytelling and fundraising, it's really important they at least understand it so they can talk the talk, but also walk the walk. I'd love to understand, how your due diligence process has changed when analyzing pre-seed to Series A companies, given their lack of data points to go on versus the robust data you were able to see when making your later stage investments in companies like Uber.
Yeah, that's definitely a transition, right? I think that there's obviously a lot more focus on the qualities and the potential of the team. And I think there's also a lot of focus that goes into the attractiveness of the market. Right. And so team assessment is almost certainly underappreciated in later stage and public markets. I actually think that that's folks that are more focused on really evaluating those teams in public markets and having a strong case for outperformance. And so it's not that it was completely not a focus at all, but I think just really understanding the folks that you're going to be on this journey with and what they're going to be good at, what they're not going to be good at, what role that you can play in these various opportunities, and whether or not that is a good contract, so to speak, right? Good partnership to have. That comes from just spending way more time understanding the various aspects of founders and their background and the way they think, the way that they interpret different scenarios, which spend a lot of time on that, right? And, I think that's been certainly a emphasis and really, I think, a really rewarding aspect of the job at early stage. And then I think when I say attractiveness of the market, it's not all about market size. Right? We tend to dig in and do a fair amount of thinking about the way that markets can evolve and the strategic levers that can enable meaningful businesses to be built from, company formation all the way through to maturity, if you will. And the other thing that we think about is there enough optionality in the market, right? To enable the natural evolution of businesses, as you know, from your experiences of working with early stage, founders, to find the optimal angle that works for them, the way that they're going to approach a certain market. It takes a little bit of time, but we spend a bunch of time understanding the market, talking to folks that are way smarter than us in these different verticals. And they tell us, hey, there are literally maybe two ways that you can make money in this market, or that, you can build a business. Those ways don't necessarily align with the strengths and, the proposition of startups. That becomes really hard. But, most markets aren't like that, right? Most markets, there are different ways to build valuable franchises, and it's about finding your stride. So we look for the combination of all of those things, including that optionality piece, to really give the opportunity to the founders to find their stride and build consequential companies.
It sounds like the quantitative side of the analytics and the due diligence process relates more to like the market and sort of what companies have done there before, how much capital do they need to get there. But the qualitative side really aligns itself with the founder and what drives them and how they're going to build this for the next 10 years, or whether or not they're looking to just get in and get out on a hot trade at the moment of time when things are really exciting. And I think for us as well at Ripple, we try to align ourselves with the founder in terms of what they want to see come out 10 years ahead, like you were saying before, but still know that there's so much work that goes in today to get there. And so they're not just trying to go from, a quick seed round all the way to $100 million valuation tomorrow, because it doesn't work that way. And so as long as we understand that what drives them is aligned with what drives us, I think that allows us to see through some of the non-data points that we don't have available at the early stage.
Yeah, I think that alignment of drive is, as you put it eloquently, that's an important vector. And so much of the experiences I've had in growth stage and later stage is, where are the laws of gravity being applied with these businesses, right? We have a good sense of how some of these businesses within certain verticals evolve, right? And where there may be natural constraints based on the business model, based on the serviceable addressable market or what have you, that makes some of the ambitions of early stage founders more difficult. And that's always been the most engaging and intellectually interesting conversations, because I've oftentimes found myself telling this story of gravity. And every so often, you just get someone who whizzes by and says, like, that is all wrong. And I'm going to tell you why. And it's a logical argument. It is an impassioned entreatise, right? Like in terms of all the different ways I'm going to flip this entire market upside down. And I love those opportunities to basically throw out everything that I knew over the course of like what I thought I learned in late stage. And, those are tremendous opportunities to back really bold and, thoughtful folks.
Yeah, keeping an open mind at the early stage is really important, to have your mind change from maybe past experiences that you didn't see work out, and not being forced to apply them to maybe a new opportunity because those founders are so good at storytelling. I'd love to jump into one other thing that I think you've probably seen a lot of given your career before. Some of the mistakes you've seen later stage companies make after raising a massive funding round that you would advise your existing early stage founders to avoid after raising a large round themselves. And what are some common mistakes you see founders make when running a fundraising process?
It's an interesting question. It doesn't need to be a $500 million round, to cause founders to face some of the pitfalls that comes with raising too much capital, right? So I like the question, because I found that it can be relevant at various stages of a company's life. And, what I found in experience is that capital tends to amplify whatever was the status quo at a company from an operating perspective, from a cultural perspective, right? So if you're thinking that you can utilize capital to accelerate your path towards profitability or drive, market share gains, more often than not, it may not do so, right? It will be a temporary fix, and it becomes this blip up, and then all of a sudden it comes all the way back down. And I think that it's counterintuitive that, the capital doesn't necessarily cause the types of excesses that you often read about, right? And on the front page of newspapers and magazines, I've seen many instances where across late stage, companies might be burning tens of millions of dollars a month, right? Staggering numbers, but everybody, including the founder, is sitting in coach on budget airlines. And it's like there's this almost cognitive disconnect between the frugal and budget conscious actions that folks are taking on a personal level, and the practices and routines and habits that you get into in terms of thinking about capital allocation at a broader scale and making those strategic decisions, right? So it's not a case of, I'm going to make sure everyone is thrifty, so if I raise a bunch of capital, I will never be that person. You really have to think through the strategy and the execution of the new capital before it comes in, right? And ideally have it be a natural extension of what you were already doing. And so that just takes a level of thoughtfulness and planning before you go and raise the potentially large quantums of capital to help grow your business. And then in terms of common pitfalls of the fundraise process, well, I think the value of being crystal clear on what one should optimize for is underrated. In typical fundraise, you go through the motions and you hope you can run a fast process and bring in a healthy chunk of capital at minimal dilution, right? You hit all of those, you've got fundraising bingo or whatever. I think in most instances those are good rules to abide by, good rules of thumb. But building a startup is hard, as everyone who's gone through it knows. And in many instances, it doesn't get that much easier as the rounds and valuations get bigger, right? You just have different sets of challenges to tackle. So if there's an opportunity to add new expertise, right, or additional strategic levers to your stable, that can have tremendous value. And that's something that is worth solving for, right? And I think the exercise of going through and thinking about what ideal partners look like, based upon the doors that it can open and the ways that it can complement the existing resources that you have available to you, that can be clarifying before you decide to go down the path of full fundraising process. And oftentimes, by the way, it can solve the typical fundraise goals that you had originally, right? As it relates to speed, as it relates to terms and all the other things, because you've just got such clarity of purpose. You've given the thought to the right type of partners to bring in. It allows for this much more organic, rich conversation where you are more prone to have a meeting of the minds than, hey, I'm just gonna, really pound the pavement without having thought about some of those things initially.
Right. And so, I think what I'm hearing is on the massive fundraising side, whether you're raising 10 million or 100 million, you need to have a strategy of what you're doing with that money and how you're going to get to the milestones exactly you described you would get to in the fundraising process. And it's okay to veer off course a little bit, but don't try to just raise all that money and then spray and pray that money around and hope something sticks. On one of the podcasts we had earlier on, we talk about it, how everyone's excited to get to the top of the mountain, but nobody understands that most of the deaths happen on the way down. Returning that capital back to investors is something that you need to do. And in order to do that, you have to hit certain milestones to get there. And so having a clearly defined strategy before fundraising and after fundraising is really important to avoid those pitfalls. And then on the mistakes around the fundraising side, you're right. A lot of people think it's, fundraising bingo, and they're just going to raise the money quickly and get back to work. Well, I'm sorry to say this, but fundraising never stops. And even after you've closed your seed round, you're still fundraising for your Series A the next day by having conversations with the investors that said it was too early and building those relationships over time so that by the time you make that call to say, look, we are raising, everything is already done. They know where your business has come from. They know where it got to and where it's going next. And you have all the material filled in, all those filled in the blanks for what they asked for when it was too early for them the last round. And so trying to rush that process, I don't think really ends up working much in your favor.
No, I think that's right. And it's a great point around, it's not just the window's open and the window's closed as it relates to capitalizing your business and finding right partners, right? That is a continuous process that one goes through. And one of the parallels of what founders and entrepreneurs go through in startups, as well as folks on the investment side as they build out their firm and find investors for their fund. You're absolutely right. It's having a more transactional mentality as it relates to, fundraising, as it relates to the type of partnership you can have, is probably selling yourself as the founder or, as the investment firm short on what you can actually solve for, what you can actually build through having the right sets of partners in your corner.
Yeah. We tell our companies the best time to be fundraising is when you're not actually needing to fundraise, because that's when you get the most honest conversations, you get the real feedback from somebody. And then by the time you really are asking for capital, they've had all those conversations with you prior that you could focus on the details of what you're asking for at that time. So I think we're totally aligned on that. Well, at Rucker Park, you focus on pre-seed to Series A in companies in US and Canada related to fintech, health and wellness, future of work, and transportation and logistics. What areas are you most excited about that you have yet to invest in? And have you noticed more competition in the areas you focus on since the onset of COVID?
Look, we're interested in all the domains that you've highlighted. We've made a number of investments in those verticals. But I think this year, through all its challenges and tragedies, it's shaping up to be an interesting inflection point for a number of different verticals, right? And interested in exploring and pulling at the thread of the structural changes and opportunities that are arising out of 2020. And one of the best examples that I can think of is small businesses. It's such a reset in the current environment for small, medium-sized businesses to rethink the way that they run. In the past, it was okay to have the friction and the inertia of running the business exactly as one had for 10, 20, 30, 40 years, because it just didn't feel like the trade-off was worth that. The trade-off of retooling and exploring new business models was necessarily worthwhile. 2020 has become such a catalyst, and we've seen countless brick and mortar entrepreneurs, business owners in local markets embrace new business models, right? And technology and innovation much more than ever before. And when you think about that as an actionable opportunity in all its different flavors, but small and medium-sized businesses employ close to 50% of the US workforce, right? And so when you think about all the different ways technology can enable and empower that massive group that is hard to generalize and say one size fits all, it is a powerful opportunity. And there are similar things happening all over the place like that, right? Real estate, lots of things hadn't changed for many, many years, many, many decades, right? And now, what a reset in both commercial real estate and residential real estate, consumer habits, all these other things. So, I would say that we are generalists by trade. We've outlined a number of domains that are interesting to us. We also have experience, obviously, in consumer and marketplaces. And so we're looking to find opportunity to back founders who are, bringing that catalyst into a major theme across all these different verticals.
Yeah. I mean, we're seeing the exact same thing at Ripple. Companies like Tread and Rose Rocket in the construction and logistics space have seen so many small businesses quickly adopt their software where before they were okay with the status quo. And now it becomes mission critical. A lot of the workflow automation tools, and especially in the remote world, when you can't sit in your office and just do a bunch of paperwork, is becoming a more mission critical software. Have you seen competition heat up in the areas that you obviously are focused on due to this, rush to invest in remote work, enterprise SaaS type stuff?
Yeah, I would say that the competition is focused in various pockets of these domains, right? And harkening back to our earlier conversation in public markets, you often didn't give companies a pass for what are known as non-recurring or one-time benefits, right? And so a lot of the work that we're doing is what is a structural change, that has been catalyzed by all the new behavior and the new, industries that have come out of 2020, and what are seemingly more of a one-time, potentially less likely to recur event that, will see consumers or customers abandon, that type of behavior once life, hopefully returns to some semblance of normalcy. And so, I think some of that rising tide of companies that have been beneficiaries of remote work and, digital health, the verdict is still out, right? But I think they certainly have attracted a ton of capital, fintech as well, right? And, I think for us, we're looking for certainly the accelerant that has, proved that there's a valid use case across different types of, market environments, industry environments for these companies. But what has become a massive opportunity in their minds of, building the next business that is appropriately calibrated for all of the different ways that we would expect to potentially, work, live, play for, the next 10, 20, 30 years plus, right?
Yeah, focusing on those long-term consumer behavior changes, not just the short-term blips, is what you're sounding like you're focusing on. That makes total sense. So I'd love to move to my favorite part of the talk, which are your book recommendations. And you have 3 amazing books here. Can you tell us about each one of these and why the audience should listen or to read?
Yeah, I could talk a long time for these, so I'll try my best to be short. So the first one, Churchill, Walking with Destiny, is by Andrew Roberts. And it's just a fantastic biography of Winston Churchill. I'm a huge Churchill fan, infatigable in many ways. And I just have great admiration for his unwavering leadership in obviously turbulent times, the things that shaped him, right? And his life was obviously not up and to the right. And you see that he stuck with his convictions, even when it wasn't popular. And despite his ambitions to lead, you get this visceral sense that he never put himself before the office that he held or above the office that he held or the ideals that he swore to protect. And I just think that that's such an amazing quality to read about, learn about, and potentially emulate as founders, as leaders. The second book, so Mastermind by Evan Ratliff, just this insane nonfiction account about a man named Paul LaRue, which was this self-taught programmer from South Africa. I think early in his life, he helped build this highly regarded piece of encryption software, open sourced it, so he didn't make a dime from it, and I think was always somewhat resentful that was a lost opportunity. So transitioned, and by the mid-2000s, he was employing his talents to set up this massive internet pharmacy business selling drugs and opioids to Americans. And, that operation was raking in hundreds of millions of dollars, all done from the comfort of his laptop in the Philippines. And of course, like any good villain, he diversified his criminal activities into all sorts of crazy stuff like international arms dealing. And I think at one point he tried to corner a regional tuna fish market. So it's one of those books that has you keep saying no way, right, out loud over and over. And you can't make this stuff up. I'm sure they'll make a movie about it or Netflix series. But I think apart from being wildly entertaining, it's also a cautionary tale about entrepreneurship, right? And technical talent gone awry. And, the role that having the right internal compass, as we've talked about, I think multiple times in our chat, can be the difference between a platform that is for good versus, a criminal empire. He was busted, so there's no happy ending for him. The last book, Evicted, was written by a sociologist named Matthew Desmond. It's a really powerful book that highlights the role that housing can play in perpetuating, and I think if you're an optimist like me, ending cycles of poverty. So Desmond goes to live in Milwaukee for a year to follow, I think it was 8 lower income, families, primarily families of color, that struggle to find or keep a home because the cards are heavily stacked against them, right? It really shines a light on the systemic issues that obstruct access to opportunity and what can be considered a basic human right. And I highlight this book partly because when I read it, I thought to myself, wow, this is a manual for entrepreneurial opportunity, right? You can do the math of, some of these homes that folks are living in and how much they were purchased for. And Desmond talks about all of this. You just notice how high these rents are relative to the home cost. And you quickly realize that there's been a market breakdown. It's inefficient. And that's where the predatory practices have come from. The landlords are over-earning, right? And you hear about the process of tenants trying to find vacant properties, and it's just an incredibly offline, analog process. And all of it points to tremendous opportunity for founders who can do really well by doing good. I read that book a couple of years ago, and it stayed with me. I can't imagine, what the current pandemic is, doing to folks that Desmond met in his books. So I just think it's an important topic that's interesting to understand, important to understand, and I think important for innovation to catalyze change.
Yeah, what a timely book, and a lot of lessons in taking the fat out of the system and not being scared as a founder to look at old legacy industries that are making tons of money and think about how you can totally break them apart and redo them the right way so that society benefits as well as the entrepreneur who starts something inside of it. And we can never get too many Churchill recommendations, so thank you for that one. And I can't wait to see the Netflix special on the Mastermind when that comes out soon. So before we wrap things up, we always ask our guests for any final words of inspiration for our audience.
Yeah, I think it's important to embrace the role of luck and randomness, what that can do to your life and the impact it can have on your business, right? I think I've seen it in my personal life in the windy road to early stage. And I've certainly seen it in the journeys of, countless founders and companies across various stages, right? You can't plan for these things to happen, but, I believe maintaining an openness to opportunity that comes along while staying true to your values will ultimately serve you well. So I've certainly benefited from being open to those opportunities and the generosity of mentors and folks I've met along the way. And if you can maintain that openness, I think lots of good can come from it.
Well, those are very wise words. And thank you so much for sharing your story with us today in the Tank.
Thanks a lot, Matt.